Good evening, everybody. Thanks for coming. I think I've met most of you in the room, but I do see some new faces here tonight, so thank you so much for showing up. For those of you who don't know me, my name is Claire Matten. I'm an advisor with Sterling Commercial Real Estate with a focus in industrial flex assets and self-storage. So I'm here to basically confirm any suspicion that industrial demand has held its position in the spotlight as the commercial real estate darling through 2022, and we have plenty of runway left to perform moving into 2023. So let's get into some of the nitty-gritty data that we saw trending over 2022. So we did see a decline, much like every other asset class, a decline in vacancy. So we're still holding below that national average rate of about 4% vacancy, down at about 3.8%. Average lease rates have skyrocketed. Some of you industrial tenants, if there are any in the room, are probably feeling that. This has happened all over the country. This is not unique to our market, and we'll talk a little bit later about why. Alternatively, sale transactions were down significantly, and that's not because there wasn't demand for it, there was just simply not enough existing product trading. And so a lot of industrial users ended up going the lease route or the land purchase and build route in 2022. The average sale price has continued to climb. This actually started back in 2020 and has continued on this upward pattern and basically shows no signs of slowing. So if $140 a foot feels high, our friends here from the Bozeman market, their existing industrial product is trading at over $200 a foot over there right now. So we know what happened in 2022, and really the only disruption in the industrial space has been the shift in capital markets, much like Connor talked about. So investment activity has definitely cooled due to the rising interest rates. That's not to say that deals aren't going to get done. They're just going to take a lot longer, with a much heavier focus on underwriting and due diligence. There's just been a big struggle in the last 6-7 months to identify what exit cap rates are going to be. And so you have analyst teams that are spending a lot more time on drilling down on assumptions, rent and cost projections, market data, to get more comfortable with their pro formas. So take note that as Montana's population has continued to grow, the consumer demand has followed with it. So we've had very little cooling in the owner-occupier demand space. And why is that? Well, that's because the cost of doing business is too great for these operators to wait for the market to cool, to forego landing. Remember that a lot of these companies, the rent, property tax, insurance, CAM line item, and the broad spec of their logistics costs is only about 3 to 6%. Most of their costs are in transportation, labor, inventory, things like that. So they cannot afford to wait. They're not going to spend their time waiting for the market to cool. They're going to land. And because of this, we don't anticipate any drop in lease rates or pricing per foot for owner-occupiers moving into 2023. So in terms of development, we're showing just over 150,000 square feet getting ready to deliver this year. Most of that is going to be the Amazon facility and the new Peterbilt facility. The Amazon facility is just over 70,000 square feet. Peterbilt's about 50,000 square feet. And then we're showing about 100,000 square feet of spec space in the pipeline. Not sure if it's going to deliver or not. Lending has kind of pulled back on a lot of speculative development, so we'll see if that actually hits. So here's a snapshot of Q4 2022 regional rates across the United States for industrial product. And remember, when we differentiate between flex industrial and industrial, flex industrial are warehouses that have a heavier office component or retail component to them, so they have lower clear height, more landscaping. These are like R&D facilities, retail showrooms, things like that, versus industrial, which is just your standard kind of manufacturing distribution facility. So here in Missoula, we're kind of hovering around this national average cap rate expectation right now. We were in the 5s, I would say, a year ago, mid 5s to high 5s. Now we're definitely low to mid 6 cap rates. And we're seeing some buyer expectations creeping up towards 7%. So there are some exchange buyers that are out there that are always going to kind of keep our averages lower in terms of cap rates, but this 6.5% cap rate point is where a lot of buyer expectations are starting to land and creeping up a little bit. So what is causing the wild uptick in rates? It's no secret that the primary culprit for the push on industrial product has been e-commerce. E-commerce currently equates to about 20% of retail sales. Pre-COVID, we were down around 16%. Then we pushed during COVID up over 20% to about 21%. We've gone down, and now we've evened out at about 20%. Analysts are projecting that e-commerce sales will reach 32% in the next 10 years. And then they anticipate e-commerce sales to reach 45% as Gen Z and millennials start to be the primary purchasers. So this is going to require warehouse expansion well into the next decade, in my opinion. And this may not mean that Montana gets every new startup e-commerce or every last facility, but what it means is profound demand for last mile distribution space and 3PL, third-party logistics, as current e-commerce companies continue to pick up steam, and velocity propels them into these tertiary markets like ours. So in a recent study, I thought this was interesting. Globe Street performed 64% of warehouse users intend to expand their U.S. logistics footprint in the next 2 years, versus 7% who plan to downsize. So with the tremendous e-commerce growth trend, something that we often overlook until it becomes an inconvenience are returns. What happens when the next wave, these Gen Z folks want to return their products? So there's an entire concept called reverse logistics. You guys may have heard of it. But e-commerce produces an approximate average of 30% return rate versus only 10% on a brick and mortar purchase. And don't you think Amazon might have figured this out with their brick and mortar facilities, or that they're starting to open up that Connor pointed out? Yeah, they don't want to deal with the returns anymore. So what reverse logistics has done has increased demand for more back-end space, not only from distributors, but from retailers as well. So the returns come in, the distributors don't have room in their space, so they're forcing the retailers to hold that product. And so that's trickled into demand for Class B, kind of functionally obsolescent space. That's getting absorbed, and then it actually merged into self-storage too. So beyond this tight hold on industrial demand, let's examine some emerging trends we're seeing across the country and those which are actually starting to hit Montana. So AI is a big topic right now, hot button issue. AI is having a tremendous impact on manufacturing. And it might be an unpopular opinion, but human and AI collaboration is a good thing, and I'll tell you why. This was a fascinating case study performed by a brokerage group out of Minneapolis called MarketWatch Advisors regarding the impact AI can have on your business as an operator. So let's look at some data points here. $35,000 a year is about the annual wage for a U.S. warehouse worker. 38 years old is the average age. This is up tremendously, which means our younger generation is not entering this part of the workforce. They do not want these jobs. Hence, we have a labor shortage in manufacturing. Each employee takes up about 1,000 square feet of e-commerce space. One robotic arm can do the same work as 3.3 employees. This is helping with error elimination. Retail processing is accurate only 63% of the time. And then there's the safety issues. Well, there's about 5 injuries per 100 feet for employees in warehousing. So, do the math on that. For 100 warehouse employees, your average labor cost annually is about $4.425 million a year. 30 robotic arms at $28,000 a piece. That average age, the average lifespan of a robotic arm is about 11 years. So let's do 11 years for an employee. That's your cost for 100 warehouse workers over 11 years. Here's your cost for 30 robotic arms. So the movement is not for full human replacement, right? This is an opportunity for humans and AI to work together to create efficiencies. So we have a dire labor shortage in the manufacturing world right now. AI is filling those jobs because it turns out Gen Z doesn't want to film their TikToks in a warehouse. John didn't like it. I guess it's not cool, I don't know. So this is helping solve the labor shortage, and it's freeing up more capital to pay the human labored warehousing jobs more competitive wages and making those positions more lucrative. So when you're driving around the country, you see a lot of these double-decker industrial facilities. Oftentimes that top floor is where all the robotic arms are and the AI products are. Okay, so last newer trend that's interesting that I want to touch on is IOS, or industrial outside storage. This has become phenomenally popular in the last 2 years, and now it's being truly considered an asset class by institutional groups. So you have Prologis, Blackstone, you have groups like this that are considering IOS a true cash flowing asset class. The trick with these is that it cannot just be any big flat piece of land anywhere. The location is key. It must be infill for it to be valuable. The outskirts, a lot of these guys can find it themselves, and they're not going to pay the rent you want on an IOS facility on something just outside of town. These are contractors and different groups like that need staging, they need materials to be held in town by their projects, so their employees can come in, pick it up from a site near their project, and go straight to it. So out-of-town spots don't really work. Zoning is your biggest challenge with these. It's very, very difficult to get the right zoning. So if you have a big flat piece of land that's infill, the right zoning, you have a great IOS spot, potential spot. The rest of the requirements are pretty standard, similar to self-storage. So paved, fenced, security lighting, office and a shop is great. So this is an emerging trend, very, very valuable, just starting to come into Montana, not a lot of it over here. It's really popular in the port cities. So IOS kind of gives me the perfect segue into traditional self-storage, and so we'll briefly hit on what's happening in the self-storage market. So you can see Missoula enjoyed another year of rent growth over 2021, 2022. We saw an average of about 6% year-over-year rent growth across Montana, and this is a big jump. Typically rent growth is right around 2 to 3%. And I predict that this rent growth is going to start to plateau moving into 2023. Operators, for the first time in 2 years, saw that typical October vacancy that happens. Usually around the fall, you get like 3 or 4% fluctuation. You get some people moving out. That didn't happen for 2 years. All of a sudden, it happened again. So I think our rent growth is going to start to plateau a little bit. It won't decline, but I don't expect it to keep growing at that pace. Sales transactions are way down now. A lot of these trade off market. Most of them don't come live. So the ones we've identified here were off market. We're pretty confident that this is an accurate number for Missoula County transactions alone. And these don't trade very often. Self-storage owners are getting called weekly about a sale, and you really got to catch somebody at the right time in order to get a deal done. So going back to what I mentioned about industrial vacancy, that big occupancy driver for self-storage was actually the overflow of commercial users and reverse logistics groups who are left with no other option but to start considering self-storage to hold overflow product. Multifamily has always had an impact on self-storage. We had continually low vacancy rates over 2022, so that also helped. We also had supply chain strain, right? So we have a bunch of operators who ordered surplus product ahead of time, then consumption slowed, and so they had all this leftover product, no room in their warehouse to store it, so self-storage became the next best option. We're tracking about 647 units delivering this year in Missoula County, with just under 500 units of new build and expansion for 2024 moving forward. So here's where storage has gotten hit. It's not necessarily a bad thing, but it's going to be along the lines of every other investment asset class. These are the implied cap rates for the larger institutional facilities as of Q4 2022. So I'm sure this has moved up by now with what's happened recently in the capital markets. So what we had in 2021 when cost of capital was historically low, we had deals trading at sub 5% on in-place NOI, low 5% cap rates on pro forma NOI. And then rent growth softened a little bit in Q3, right? We had some people starting to move out again. And so underwriting moved back to in-place NOI rather than pro forma. And now Q4 2022, moving into 2023, now we're in these like low to mid 6 cap expectation price points again. We have sellers with performing assets that don't feel like it needs to trade at that number. So we have a kind of a stare down between sellers and buyers now. All right, so self-storage. If you are thinking about selling, anticipate changing values due to what's happening with the 10-year treasury and longer days on market. Those deals will take longer to get done. Exit cap rates we're still not sure on. If you're thinking about holding, anticipate that rent growth slowing a little bit, not declining, but slowing. And then if you're looking to build, make sure the market's ready for more square footage. Do a demand study. We're able to help with those. They're really, really important to try and project if the area you're thinking about building in can absorb what you're thinking.